We're going to hit this one more time. Don't know when exactly, but it's going to be quick, it's going to be sudden, and it's going to be brutal for anyone who doesn't have silver. Well, hello there, my friends. Rafi here from the Endgame Investor with this week's silver report for Arcadia Economics. And what do we got in the docket for you today, this week? I'm going to start out with a little bit of commentary on Brazil. It seems that free speech has died in Brazil, or will be dying within the next few hours, as X, formerly Twitter, will be shut down. We're going to look at the Brazilian currency, what happens. This is a test case. It will be a live test case for what happens to a country's currency when they evict the last smidgen of freedom in the country and it becomes a practical dictatorship. Look at the rate of Brazilian monetary inflation, which has, of course, accelerated in two phases, one post-2008, one post-2020, and it is well on the path to hyperinflation, as with most countries these days. The silver to commodities ratio has reached old highs. It looks like a potential triple top, but it won't be a triple top because the silver to commodities ratio will continue to rise, meaning silver will continue to be more valuable relative to other commodities as its monetary nature slowly creeps out of its hole where it's been since 1980. And good news for all miners, including our sponsor for TUNO mining, symbol FSM, that the gold to oil ratio is at its second highest ever, if you exclude that crazy time when oil was priced at negative $35 a barrel, when of course the gold to oil ratio at that point went to infinity and beyond.
To infinity and beyond!
The US money supply went into brief deflation for the last 2 weeks, and it looks like we're back into inflation right now, meaning the amount of money that is added to the money supply every week. But even though the money supply is very slowly growing, the inflation rate, the monetary inflation rate of the expansion of the money supply is still below, well below the trend line of the 2008 to 2020 era. And finally, we're going to look at the rate at which dollars are becoming unbacked by any asset whatsoever, meaning backed by deferred assets on the Federal Reserve's balance sheet. These deferred assets are the accumulation of losses by the Fed. By my calculations, 0.15288% of the monetary base becomes backed by absolutely nothing every week. And we'll do some calculations as to when every dollar is no longer backed by any asset whatsoever. And all you have is the gold on the Fed's balance sheet, plus a bunch of deferred assets. But I don't think we have to get to 100% of the monetary base backed by literally nothing before we get to the hyperinflationary turn, which will happen well before then. Finally, Bloomberg talks about the reverse repo situation and why repo rates are poised to rocket higher, just like they did during the repocalypse. And it even uses the term endgame. So the first thing I'm going to cover today, just because I felt like it, is Brazil. Lots of news out of Brazil that freedom of speech, or the last bastion of liberty as we know it, is under attack in Brazil. It looks like X is going to leave the country. We'll see what happens to its currency as this attack progresses. It's probably not going to be very good. We already see that the Brazilian real is near an all-time low versus the US dollar. This goes back to 1995, but I have the chart here from 2000. Once this support zone is broken, the real could collapse here, especially given the political developments in that country. And we have here the inflation rate of the Brazilian real supply, meaning how fast is it increasing. We can see here very clear stages in the inflationary destruction of this currency. We have the rate of pre-2008 when the slope of the line was over here in green, and then I changed it to red as we got it from 2008 to 2020. The slope was pretty consistent, much steeper than it was pre-2008, and now we are in the deliciousness phase because I decided to call it that. It sounds nice, and maybe I'm a little bit hungry. So we have here the deliciousness phase of the hyperinflation of the monetary supply in Brazil. And we're going to reach another stage pretty soon where the curve with the slope is going to be undefined, as I learned in Algebra 1 in 8th grade or 9th grade. No, actually 7th grade, whenever that was. The slope is undefined in a vertical line. So when we get to an undefined slope of monetary expansion, that's when you have hyperinflation. And, we're almost there. This is the silver to commodities ratio, and it has reached what looks like the high. I'm excluding these two highs here, the one from the 2011 top at 50, and this one from when commodities went way, way down in a lockdown frenzy that cured everything and solved all our problems. Yay, lockdowns. So it's here, this really is the practical top of silver as a commodities. It was the top from 2011 all the way to 2013. And we reached it here in the 2016 top in gold and silver when the bull market resumed, at least in dollar terms. And then we're at it again. But I think this time we're going to break it in a sustained way, not in this way of 2011 top or the lockdown way, which gave still gold and silver an unfair advantage as other commodities went down because people were locked in their homes. But here you see that silver is slowly coming out of its monetary shell and showing that it rises over time versus other commodities as it should and as it will continue to do. This chart is brought to you by our sponsor. Not literally, I put this chart in, it's my decision, but it could be brought to you by our sponsor, Fortuna Mining, symbol FSM. This shows you the gold to oil ratio since 1974. And the red line is where we are now at about 33.568. That's the close in the upper right corner over here. And so I drew a line to see, have we ever been above that ratio? And the answer is, excluding this infinity thing here during the lockdowns when oil went negative, we were above it one time during the February 2016 oil crash from December, maybe February 2015, 16, something like that. Yeah, it looks like February 2016. That was when oil crashed, I think, to about $35, and as opposed to negative $35 over here. But excluding that crash and this crash, we have never been at this ratio. It is the highest, second highest ever. If you count this as one, then this is number two. What does that mean? That means that profit margins for miners, for example, like Fortuna Mining, are near record highs. This is the baseline for miner profits, gold and silver miner profits, because what do? They buy oil and they sell gold. And moving to page 9 of 51 of the investor presentation for Fortuna Mining, we can see Q2 2024 consolidated financial highlights, just so you see where they've been going. Sales are up 64% from previous quarter last year. Adjusted EBITDA up to $112.7 million versus $44.4 million. Free cash flow rockets higher about 4 times, quadruples from 9.5 to 38.6 million. And finally, adjusted attributable net income up 2.5 million to 30.4 million. This is thanks to the accretions from the Ivory Coast mines, Séguéla specifically, and more mines will be coming online in the quarters ahead. So we can expect these numbers to go even higher. But from there, let's continue with the slides. This is the quarterly annualized money supply growth rate for dollars in the Federal Reserve banking system. So we have here, this line over here is 0%. This means absolute deflation, anything below this line. And we've seen here that we were in absolute deflation from about June 2022 until the turn of the year 2024. So almost a year and a half in absolute deflation of a shrinking money supply. There was a brief spurt in the inflationary rate here of increased money supply, and then we dipped below zero right here for I think 2 or 3 weeks, and now we're just above it. We're going to be meandering around the zero line for a while. That means that we're running out of steam here. And if you look at the absolute money supply, this black line, I'll explain in a second. This I drew this black line and put it as the trend line for 2010 until 2020. So this line represents the slope of these little bumps over here from 2010 to 2020. And then I took that line and I moved it up to see if the current slope of money supply growth matches the 2010 to 2020 trend line. And it doesn't. We're still below that trend line, even if you count from here. Even if you want to count the money supply starting to grow again from here, or just before the turn of 2024, we're still below that line and falling. So even though money supply is growing very, very slowly, and we're not back up even to this trend line from 2010 to 2020. Now, this is an interesting chart. I have to explain it. I contributed it myself. So this is the weekly losses of the Federal Reserve translated into percentage of the monetary base. This is how many dollars, what percentage of the monetary base is becoming deferred assets. Deferred assets are assets that do not exist, and they are on the Fed's balance sheet because they owe it to the Treasury. And this is the percentage of dollars per week that are backed by deferred assets, things that do not exist. We say that the dollar is not backed by anything, but it is. It's backed by some amount of gold, some tiny amount of gold versus the amount of bonds. It's backed mostly by bonds. I think 92% bonds or treasuries. So those are the assets that back the dollar, except the deferred assets literally are not anything at all. So we have here 0.15288% of the monetary base per week is turning into deferred assets. If you do the math of 100 divided by 0.15288, you get a theoretical number of 12 years. In 12 years at this rate, all dollars will be backed by deferred assets. Now, obviously, there's going to be a crisis way before then. You don't need 100% of your dollars to be backed by literally nothing to enter hyperinflation. The actual amount you need is much, much lower than that. I don't know what the amount is, but it's not 100%. Right now, cumulatively, we're about 3.2% of all dollars backed by literally nothing. And this is going to rise as QT, quantitative tightening, continues, and the Fed continues to accumulate more and more losses every week. That black box there are the figures that I averaged in terms of what percentage of the monetary base we are losing to deferred assets every week, and that's how I came up with 0.15288. Now, finally, just a reminder that the ultimate endgame bell, when do we know that the monetary system is dead? We will know because of silver, the gold to silver ratio. That will be the bell. Why will it be the bell? Because silver is the public's money. And when the gold derivatives finally fall and gold goes to infinity in dollar terms, the gold to silver ratio will fall to 15-1. And you can see here on this chart going back to 1800 why this is. There's like a wall here, a hard wall that you can't get below. And this is the 15-1. It happened 3 times since 1873, the crime against silver. 1919 over here after World War I, 1968, fall of the London gold pool, and finally 1980. We're going to hit this one more time. Don't know when exactly, but it's going to be quick, it's going to be sudden, and it's going to be brutal for anyone who doesn't have silver. And I'd like to end this with a verse from the Bible, Amos 2:7. It says, I quoted the Hebrew here, but I'll just read the English. Thus said God, for 3 transgressions of Israel, for 4 I will not revoke the decree. So what I'm saying is there have been 3 trips to 15-1 in the fiat monetary era, but the 4th one will be permanent because they have sold for silver those whose cause was just and the needy for a pair of sandals. When will we be selling anything for silver? That will be on the 4th trip down to 15-1, which will happen sometime over here. And when it does, you want to take your silver, you want to buy anything you can, anything on offer. And if you can't think of anything to buy, then I would trade your silver for gold and lock in your gains and then decide what to do later. And here we are, Bloomberg, banks likely endgame in quotes for repo market as Treasury supply grows. With balances at the Federal Reserve's overnight reverse repo facility, or RRP, which I talk about a lot, considered an alternative to T-bills or private market repo, potentially close to being drained, meaning RRP is potentially close to being drained. Actual bank participation in the market is more critical. So meaning when the RRP finally runs out, it's banks that will have to lend to the repo market or the repo rate will explode just like it did in September 2019. And that's in the next paragraph here. That's becoming all the more important for market participants who rely on the repo market for real-time indications of stress, like the ructions. Ructions, that's a good word. I'm going to use that word more often. Ructions seen in September 2019, that was a ruction, as the Fed gets closer to the end of its balance sheet unwind. And here is the quote. Banks will eventually become the end game as the marginal cash lender in repo markets. He wrote, I think this is the same Jason guy, right? Jason Williams. So Jason Williams is our new end game investor. Congratulations, Jason Williams. Welcome to EGI. If you've been reading this blog, I'm proud, though I would seriously doubt it, but who knows? This is Rafi, the Endgame Investor, with this week's Silver Report for Arcadia Economics. Check out my channel where I talk about Bloomberg talking about the endgame and the repo market this week. And don't forget to sign up for the Endgame Investor on Substack for free. And I'll see you guys next week.